3, 2, 1.
And we're live. Welcome to the Marketing Trench. Today we're going to be talking about the market, and the reason why we think this matters is because any good sales and marketing effort is going to require you to be knowledgeable. Right now, all of us are getting emails, we're getting phone calls, we're getting DMs. Mostly Ricardo gets DMs on the account that's his OnlyFans account. But anyway, it doesn't matter. The point is, we're all having people reach out to us and they're saying, hey, are rates going to go up? Are they going to go down? Is now a good time to buy? It seems like prices are overheated. Am I going to lose money? All these big questions, you probably are experiencing the same set of questions. And you're trying to figure out, what am I going to say on Facebook about market trends, whether it's a good time to buy or sell? What am I going to say in my email blast this month as I sit down and craft my email newsletter, or whatever the flyer drop off you're going to do in your local farm? And so today we brought on Josh Lewis. He is with Buywise Mortgage, which is also Scott's company. They are business partners over there. And Josh is one of the smartest people, I think, in the mortgage industry in terms of people who are paying a lot of attention to the data, who are also actively involved in the industry, who are commenting on this sort of stuff. He hosts a weekly podcast on this topic, and it goes really into depth. So today we're gonna try and pull some of that depth of thought to our own show and help you to be able to think about this market, think about what's shaping it, and know how to talk about the trends as they're emerging and as you're putting your sales and marketing together. So that's what we're up to today. Josh, thanks for joining us. How are you?
Not too bad. We're in the great state of Texas today, so I'm free from the constraints of liberalism and feeling much, much better about life.
You're not moving out there, are you?
Well, that wasn't the plan. This beautiful kitchen here belongs to one of my buddies, and we got here, and I'm like, wait, you paid how much for this? And it's so beautiful and nice, and you can go places, and people are friendly, and it's open and wonderful, and you don't pay taxes and things of that sort. So who knows? We'll talk to the boss. I've been asking leading questions like, what do you think? You think you could live out here? Would you like this?
I think you're really underselling the value of having homeless people take a dump on your lawn.
Yeah.
But that's probably a set of topics for another day.
Grass is always very green in those spots, yeah.
So Josh, I told you in our private conversations that I think interest rates are going to continue to go up, and you think I'm wrong. So maybe that's a good place to start, because I don't feel like I hold a minority opinion here. And I hear what I'm saying a lot out there, but you did send me some articles. Let's dive in. Why do you think interest rates are not going to continue to climb throughout 2021?
So in the short run, they absolutely could. So the big number that came out today was a producer price index for the month of March. Was expected at 3.8, which would have been the highest figure in about 10 years, an increase of 3.8% year over year. It actually came out at 4.2%. That's a trend that we're going to continue seeing for the next several months. So on Tuesday, we get consumer price index, which is much more important to the bond market. Producer prices are wholesale, what goods producers are paying to put their goods together. Consumer prices are when it actually filters through what we're paying on a day-to-day basis. So in theory, producer prices only matter to the extent that those price cost increases get passed along to consumers. So we're going to see on Tuesday. But what we're going to see on Tuesday is it's going to be a hot CPI figure. There's no two ways about it. The way that CPI is calculated is they take the monthly figure over the last 12 months and they total them up. So if we have a 0.2% month over month increase over the last year, you have 2.4 for the month. So we've been having a hard time getting above and sustaining 2% inflation, which is kind of where the Fed wants it. You want prices increasing over time. You don't want them increasing at such a rate that people are losing buying power. But there's a psychological impact to, if you know that the car you want to buy or the house that you want to buy is going to be a little more expensive next year, then you have an incentive to get out there and buy it. The flip side is deflation, and deflation is really problematic because if you know that the house or the car you want is 5% cheaper next year, you're not going to buy it. You're going to wait and hold off. So there's always this little dance. The Fed wants CPI at around 2%. We're going to see somewhere around 2.6-ish next week and before it peaks. So imagine, let's talk about why that is. When you have the last 12 months in aggregate, so last March, the first really bad month after COVID, which we had a negative print, it was like a negative 0.2, that falls off. And this year's plus 0.3 comes on. So you're going to have a 0.5, 0.6% increase in year over year CPI. And that freaks people out. So something we probably should talk about, in February, rates went up like straight line up. We went from your best qualified borrowers in the 2.65 or 2.625 to 2.75 range for a no cost or at least a 0.0 lender fee refinance purchase. You're in that 2.625, 2.75 range. And now we're in the low threes for most of those loans. So let's just say up a little less than 0.5%. And the reason for that is everyone starts talking inflation. And there's a saying in the markets that it's buy the rumor, sell the fact. And this is almost the opposite. They were selling bonds on the rumor that inflation was getting out of hand. And since that time, we've seen the markets level out. Yeah, actually, interest rates improve a little bit, not much, but a little bit. And the reason for that, I think, is that the Fed got out in front of it and said, we're not changing our policy. We still need a ton of stimulus, and we are going to let inflation run hot because we think it's transitory. You have those 3 really bad months from last year, March, April, and May, when everything was locked down before they let things reopen in June, July. We had really low, like negative CPI numbers. As those fall off, we're going to have really hot numbers. And there's some truth to it. It's not just the year over year comparison. We also know supply chains got shut down. There are changes, lumber prices, commodities prices, those are all up. So in the short run, there's some inflation in the system. But if you're talking about a 2-year bond, a 10-year bond, a 30-year mortgage-backed security, do you really care about the next 3-4 months? No, you care about 1 month or 1 year, 3 years, 5 years down the line. And when you look at that, we have massive, massive headwinds for growth in the United States. And in simplest terms, if someone asks me why rates cannot go higher and will not go higher, when I say that, it doesn't mean that February couldn't happen. It did happen. We went up 0.5%. And we could go to as high as somewhere in the 3.75 range before we started having real issues and the Fed would have to jump in and do something. So when in simple terms, what does that mean? The Fed buys treasuries and they buy mortgage-backed securities. And by doing that, they're making sure that the prices paid for all of these bonds are higher and the yields are lower, and they keep yields artificially low. And if you look, when Obama left office, I'm not saying anything, when Obama came into office, so this isn't an anti-Obama statement, it's just a point in time. When Obama came into office, there was a $7 trillion national deficit. By 26, we're going to be over 40 trillion. So the thing I tell people is, if you owed $7,000 on your credit card, and over 12 years, you maxed it out at $40,000, but you controlled the interest rate. You could control the interest rate. Would you let that interest rate go higher? Could you let that interest rate go higher? So if you're a billionaire, who cares? Yes, you would let it float that way. But the United States does not bring in as much money as they spend every year. We run a deficit annually. So they can't pay the bills as it is. You think we can pay the bills with higher interest rates? We have the current president wanting to spend more money. So the infrastructure is definitely needed. There's some political will to spend money, but it's, again, we're just adding more to what's owed on the credit card. So we cannot have higher interest rates. So just put it in context, the debt service on that national debt, the debt has been going up, but the debt service, the actual cost to finance and pay that debt, has decreased because rates have dropped through that whole 13, 14-year period. So you get diminishing returns. It's not having the stimulating impact that it did in the past, and it won't, which is one of the reasons why GDP continues to remain lower than wanted and desired and likely to stay so. You're just looking at a situation where we're going to have longer term low growth, low interest rates, and this is globally, not just here. So again, I don't want to get too deep in the weeds, but like, I would bet a lot of money that we're never going to see higher interest rates. We're just not going to. There's only 2 options. The government can't afford to pay higher interest rates. So either the United States defaults on its debt or they artificially manipulate rates lower. Those are the only 2 options. And I prefer to not think in terms of the Armageddon that would ensue if our government defaulted on its debt.
Well, and plus, historically, it's the U.S. has shown that it will lower the interest rate so that it is reducing the amount. It is reducing that rate, right? So, I mean, that's already the trend. The other question I wanted to ask you, Josh, because like Dustin said, you're the smartest person I know on all of this stuff. With the inflation stuff, is the inflation that everybody is freaking out about, is that relative to, I mean, that's relative to zero production, right? I mean, that's because we artificially closed down the country and shut down industry and shut down businesses so that it's not a natural market. There's not inflation because of natural market natural market patterns. It's an artificially inflated number relative to zero because we shut the country down, right?
It would be the same as if you lost your job last year and you're out of work for 90 days and then you got a job and everything was good, but we're looking at month to month figures over last year. So last year, that 1 month of unemployment drops out and now your average income spikes back up. If we go back 2 years, you're not making any more money. You're just back fully employed. We're just back to the status quo at best. But on paper, this looks like, whoa, things are much better for you than they were last year. That's really the only point of comparison. It's not this hot inflation. And I shouldn't say that. There is some of that in there. Oil prices are higher. Lumber prices are higher. Gold prices are higher. So there are some things in there. And we had supply chains shut down that couldn't just open back up. So again, producer prices, the prices of these goods is up. But the Fed is 100% correct in this regard, in that it's transitory. These are not permanent structural changes that are going to lead to a higher rate of inflation that would lead to the need for higher interest rates if, assuming the government would and could allow them to be higher.
So I saw something, I think it was a loan officer or a real estate agent on Facebook, showed a message that they got from that their client got from the builder. And the builder basically said, we have to increase the price. We know we're in a contract, but here's an addendum. We have to increase because lumber costs have gone up so high. What kind of conversation are we having with people that want to buy right now, or like maybe want to buy new construction? And there is this temporary window, and maybe that's a better question, is if lumber prices are higher because supply chains were squeezed, in a number of different reasons, when can we anticipate that goes back to normal? And are we talking to our clients about, so are you having a conversation about no, buy now, because in the next 5 to 10 years, maybe the first question is, how long are you going to stay in the home, right? Because even though the price is a little bit higher now, equities, due to lack of inventory, home prices are going up at a minimum of what, 7-8% a year, right?
So here's some scenarios that I've heard. My buyer wants to wait because they're seeing they're losing out on the offers they're making, and they're seeing homes selling for 50, 60, 80,000 above asking with no contingencies. So they think that's crazy. I'd rather rent for another year, wait for this craziness to cool over and prices to come back down.
Meaning that
how do you handle that as that's the objection the consumer is giving?
So hold on, you guys just Dustin had mentioned earlier here. I am a humble guest on Jeb's YouTube Live every Wednesday. Jeb Smith, my buddy, who's also been a guest.
Hold on. Jeb is a humble guest on the show that you are on. I think we should all
it's his channel, so I think he would slightly disagree with you. But he and I do a YouTube Live every Wednesday from 5 to 7 p.m. Pacific time. And in 2 hours, we get about 400 questions or comments and about 2,000 people through during that hour. It peaks at about 300 people during those 2 hours, by the total of 2,000. And the reason why the live numbers are important in this context is it's a live conversation with real buyers, and not just in California. So for me, we're only approved, Buywise only does loans in California. Very few new construction homes in California. So we do 2 or 3 a year. It's not something that comes up often. But around the country, in most markets, new construction is an absolute option. So what are the most common questions that we're getting? I'm tired of getting beat out. Should I just sit on the sidelines and wait? I'm tired of getting beat out. Should I just go to a builder and pay the price and step in and get something under contract right away? And these are really good questions. And in most parts of the country, as an agent, as a lender, you better have an opinion, an educated opinion on what they should do and why. So in answer to the question, should I wait? I say, well, wait for what? Should I wait till this stops and then I can get into a better point? So when you look, the numbers, everyone can pick their favorite headline that we've seen. The house in Sacramento that had 122 offers, the one in Austin that had 80 offers, the one in Washington, D.C. that was 76 offers, 40 of them were all cash. So these numbers are insanity and they're everywhere. But let's say if you go out and you get into a mild bidding war and there's 12 offers on a home and there's 2 cash offers and someone pays a crazy number. You go, you know what? I'm going to wait till this works its way through the system. Now, when there's 70 offers, how are 70 of them going to work through the system? 69 of those people missed out, and they're going to go, let's say half of them throw in the towel and say, I'm going to wait till next year. You have 35 people bidding. People say, well, I'm going to wait till more inventory comes on the market. Okay, first of all, you have to believe there's a reason why more inventory will come on the market. But let's play a thought game and say, okay, you're right. Let's say 3 times the inventory comes on the market. Now we have 30 people, 3 times the homes. Now each one, it's a 10-person bidding war. Nothing is going to change in the next 24 months that makes this better. A conversation that Scott and I get to have every 2 weeks is with our friend Phil Bracken and Tino. Why am I drawing a blank on Tino's last name, Scott? Tino Diaz. And these guys, old dogs, they're young spry fellows, but old dogs, they've been around, they've seen a lot. And the conversation the last 6 or 8 weeks is, when is our government going to pull their heads out of the sand and start doing something here? The number, I don't know if either one of you guys or any of you 3 guys saw the article in the Wall Street Journal this week. KB Homes built a new development a year ago in Houston, 126 homes. So you're like, cool, that's 126 housing units added into the Houston market. Well, not exactly, because what they did is they put tenants in all of them. They waited a year and they sold it to a hedge fund. And that hedge fund is going to run them as 126 rental units. So instead of owning an apartment building, they own a planned community with 126 rental single families. One of the big myths that we heard after the meltdown in 2011, 2012, 2013, when hedge funds started snapping up single families all around the country, it was, hey, they're going to buy these at a discount. They'll take the rents and get a yield on their investment for 2, 3, 4 years. As soon as the market recovers, they'll sell those back into the market. So we talked about we didn't talk about the consequences of low interest rates. It's super easy for everyone to say, hey, low interest rates are awesome. I refied from 4% to 2.625. Well, that same yield that the investor making that loan at 2.625, every hedge fund, every pension fund that is looking for yield everywhere is looking at single family residences and going, wait, we get some tax shelter there. We get some appreciation, we get some yield on our money, and we get some appreciation on the investment. Why would they sell when they have nowhere to go? So that's what we've seen. We have some friends of ours, smart people, I'm not going to name names because they are smart people that I respect, saying last year when COVID jumped off, we've heard that Fannie and Freddie are telling their big institutional holders of single families they got to dump these into the market, and it's going to make this be a bloodbath. It's the whole thing. How many times have you guys heard this in the last 10 years? Oh, there's all this shadow inventory that the banks haven't sold. No one has documentation of it. No one's ever seen it, but magically it exists. Yet what do we see every day? We have millennials coming into prime home buying age. The peak, it's not even the peak. Over the next 3 years, we'll have the biggest group of millennials hitting 33 years of age. 33 just happens to be the median age of a first-time home buyer. So you have massive amount of supply. Baby boomers are not selling homes at the rate that they were expected to. We haven't built homes, and we have massive institutional investors coming in and taking supply out of the market. So again, wait for what? What is going to make it better? Now, there's a possibility that I could be wrong. Let's just say in the context of this conversation, we're talking to mainly realtors and lenders from around the country. I could be wrong. The important part is not that I'm right or wrong. It's that I've researched it. I have the information, and when a client asks me about it, I know 1,000 times more than they do, and I'm 1,000 times more likely to be right than them. So if you don't have that knowledge, if you haven't done that research, you're creating a knowledge vacuum there. And your client's not just going to go, well, that's okay, we don't know the answers to that. They're going to go and seek the answers out themselves. You know, Scott was talking before we came in here, they're going to go to YouTube. You want to know what the #1 most popular real estate video on YouTube has been for the last 12 months? The coming 2020 real estate crash. And then the calendar rolled over, and now it's the 2021 real estate crash. And in 2022, it'll be the 2022 real estate crash. Yeah. So they're going to go and they're going to hit these clickbait headlines. They're going to get crazy information. They're going to put their head in the sand, go back home, keep renting, and next year, because what's going to happen? So you can
So let's see. You rent for $3,000 a month. That's what, 30 some odd thousand. I suck at math.
36,000, Ricardo.
It's $36,000 a year. So now you've lost $36,000 of purchasing power. Rates might go up, and you lose how much more in purchasing power?
We already covered that part, Ricardo. Rates aren't going up.
So when the rates go up and the market crashes,
yes, that's when you buy in.
So you always have this conversation about, okay, you've got the home price. So let's say you pay $50,000 more for the home than what you think it's worth, or whatever the case is. But again, because of the conditions of the market, because there isn't a shadow inventory out there, and because especially if interest rates are going to continue to go down, it's not inconceivable that property values are going to continue to skyrocket. They're going to continue to go up at a pretty decent clip, right? So equity increase, compound equity over a 5-year period versus you rent for 5 years or whatever, that is a huge spread. I've heard you say this before. Go through a typical scenario of I'm not going to pay $30,000 more than this house is worth right now. I'm going to wait for a couple of years until home prices come down. Like, what are you missing out on this? I mean, it's almost an old buy versus rent conversation, but it's a little escalated because of the market conditions.
So, you know, Scott, we've always talked in our webinars and in educating consumers about the 4 factors. Homeowners have 44 times greater net worth than renters, and there's a reason for that. 61% of that net worth is in home equity. So why? Why is that? The 4 factors are: there's no 30-year fixed rent. So in Ricardo's situation, the $3,000 rent this year is $3,150 next year. It's $33 the following year. It's $36. One day you look up and you're paying $4,000. So for us in California, the rent versus own is pretty tough, because you're telling someone, hey, it's going to be $800 or $900 more a month for you to own than it is to rent. So then we come to what's the next factor. It's that is an amortizing mortgage. You basically have a forced savings account every month. And if you're buying a $700,000-$800,000 house in California, you're putting over $1,000 a month into that savings account. So in your instance, if you pay over $30,000 over what you think is fair market value, but 50 other people are lined up and saying, no, this is fair market value for the home, you're going to get 12 of that back just in principal pay down over the next year. Let's say that the market slows horrifically and that $800,000 house only goes up 3% in the next year. It's gone up more than 3% in the first 3 months of this year, but let's say in the next 12, it only goes up another 3%. That's $25,000 of appreciation. So you paid it down 12, it went up 25. That's $40,000. So cool. You won the war. You didn't get into a bidding war and overpay for a home. Well, you won the battle, but you lost the war, because a year from now, the idiot that overpaid that you're laughing at is going to go, well, this is cool. I got a house. I redid my yard. I put some plants in. My kids are in a new school district. We're having fun. And you're still renting, going, when do I get to buy in?
Yeah, they're almost, even in that scenario, they're almost break even in 12 months in that scenario. And that was an exaggerated scenario. Now, when you talk about 3% appreciation, what was the national, what is the national average of appreciation typically? And
historically?
Yeah.
Historically in that 3 to 4% range, but it varies. You know, in California, we're at like 6 to 7% going back to the 70s. And that includes the massive drawdown in 2008, 2009, 2010. Like, so on Jeb's YouTube channel, the thing that I'm famous for is telling people that numbers never lie. It's great that you have thoughts and emotions and opinions. Let's pencil it out on paper because people have no idea. The numbers that we just ran through, most lenders and definitely call center lenders, when you're pushing button and getting mortgage, no one is walking you through these numbers and telling you what it looks like so you can make an educated decision. It is uncomfortable and unfortunate to be paying thousands of dollars over list on a home. It is unfortunate and uncomfortable to write 20 offers to get one house accepted or one offer accepted. But it's the reality of the current market and what is the flip side of it. And I don't ever want people panicking or making rash decisions. But the only thing that could bring down the current housing market, you never say the only thing, the biggest risk, the risk that could happen would be higher interest rates. And higher interest rates can't happen. So it's actually more likely to go the other direction and rates continue to inch lower. Like one of the things people want to talk about, these home prices, they're higher than the crash before the crash in 2007. This isn't sustainable. Okay, cool. Why? Well, because they're higher than they were before. And that last time they crashed, you're like, okay, well, that was 13 years ago. And what has happened to median income since then? Oh, they're up 40%. Okay, so then home prices, which are leveraged on that, should actually be up more than 40%. And if we take a long-term trend, not every area of the country has really good data. California does have really good data. If we take a long-term linear trend of where home prices should be, we are just now slightly above trend. And more importantly, I don't care so much about what the trend is. No one gives a shit. Sorry, I broke your G-rated rule for the podcast. But no one cares how much their house costs. If I told Ricardo, I have this beautiful $5 million home, I would like to sell you, you don't need to put any money down, and it's $2,000 a month. Ricardo says, where do I sign? When do I move in? Where are my keys? And that's the way home buyers look at it. And the reason why home prices look historically high, I saw a really smart person that I trust and love his numbers. He has as good an analytical mind as I know. But I watched a 2-hour presentation he did, and I was fully on board with about 90% of it. But one of his charts was showing, well, this is a red flag because home prices are at a historically high multiple of median income. We're at 8 times median income right now. We got to 10 times before the crash, and that was because, if you remember, no one actually had to make money. They just could say what they made. So median income on paper lost any correlation to what home prices were. So we were at 10. 8 is a historical high. And he's like, I don't know, that's a red flag. I go, is it? Because no one cares what multiple of their income they allocate to housing. They care what percentage of their household income goes to the payment. We have interest rates that are in the twos for most people.
The difference, because I understand what you're saying, I think, but I don't understand the difference between those two things. So
Historically, in California, we would peak at about 5 times multiple of household income to home value. So let's say if median household income was $100,000 and peak is 5x, that means once you get to about 500,000, you're at the peak. Well, right now we're at 8 times. So you're like, well, that house is $300,000 overvalued. You're like, no, because historically that 5% was with an 8% mortgage rate. What does that payment? What does that payment look like relative to a 2.75 or a 3.125? They're very similar. No one talks about real home prices. And you go, what do you mean real home prices? When you normalize for income and interest rates, they're very stable. Homes are more affordable, much more affordable than they were before the peak, before everything crashed. And what could cause that to be thrown out of whack? We could have a bunch of people lose their jobs, which we saw that temporarily last year, but it was primarily like hospitality jobs on the low end. We didn't have a lot of homeowner, higher income earners losing jobs, but something could happen. We saw that. There's things that we can't predict or see or imagine. That could come into play. So the other thing is interest rates shoot up, and they just can't.
But the relationship between the value of a home and median income is interesting, because if you're a new home buyer or someone who's going to be a first-time home buyer, you're looking at that and you've got to deal with debt to income ratios. You got to also deal with coming up with a down payment. And so the fact that the home is valued at that astronomical rate, even though the person who's in it right now might have a killer mortgage at like, $2,500 to $3,500 a month, you as a first-time home buyer aren't going to be so lucky And that to me seems like a huge problem. So how do you reconcile that?
No, that is 100% the issue, because affordability, people keep asking me, like I have some clients that are buying a $900,000 fixer down in San Diego. And they're like, you know what? He's in construction. So he's like, we're going to go in and get it dialed in. I think 7 or 8 months. I'm just going to get the hell out of there and put it back on the market. I get $1.1 million for it, put $100,000 in our pocket and move on down the line. And I go, cool. Well, what makes you think that $1.1 million is the peak or it can't go higher? He goes, well, who could afford this? This is basically like an entry-level home. And you're like, well, it's not an entry-level home. Median for San Diego is like high 6s, low 7s now. So you're like, no, that's not an entry-level home. But his take was, well, who can afford that? And I go, well, we look at every house in that price range that comes on the market. There's about 15 to 20 people lining up that can afford it. So let's say that some of the mania subsides. There's still 2, 3, 4 of them. Like if you look at numbers, you have to know your numbers. What is a balanced market? Most experts consider a balanced market, balance between sellers and buyers, where neither one of them has the leverage, is 6 to 7 months of supply. Most everywhere in California is barely over 1 month. So how much more supply can come on the market and how much demand could dissipate before you see anything approximating a reasonable balance? It's not coming anytime soon.
So one thing I wanted to mention, because we want to make sure that we give some good takeaways here. And I would like to maybe spend the last 15, 20 minutes, if we can, maybe kind of converting some of this into conversations that we can have with consumers. Now, obviously, if the homes are being so far outbid above appraised value, you're going to have to cover that gap between the appraised value and what the purchase price is. But Josh, in a case, maybe in middle America or something, maybe it's above asking price, but you can still get your loan amount go up. And you're like, well, I don't know if I want to borrow an extra $40,000 or $50,000. You're not really out $50,000. Your mortgage payment increases how much?
The numbers are all over the place because every situation is different. But let me answer that by circling back and closing the loop on Dustin's question. The biggest problem that we have is as prices go up, that entry-level buyer has a bigger gap to cross. So FHA 3.5% down on a $700,000 house is still $25,000. I have far more people that can debt to income qualify for the $700,000 house than can come up with the $25,000 plus closing costs. Now, where does that dovetail with the appraisal issue? It dovetails in that we have a ton of first-time buyers with minimum down, and they have no way of crossing that gap if the appraisal comes in low. So if you just scrape together the 3.5% down and we're giving you a slightly above market interest rate to get the lender to cover all of your closing costs and prepaids, you only have enough money to get in there. So the appraisal comes in $10,000 low. You don't have a magic mattress over there with $10,000 stuffed in it. You're just out of the game. And that's what we're seeing why first-time buyers are getting screwed and pinched here is it's going to the guy with 20% down or cash. Regardless of whether the seller wants that to be the buyer, they may love you, love your family, want to put you in that home because their neighbors are going to think you're fantastic. They can't take that. And it's funny, I keep seeing realtors or people popping up online, or even the people that show up to our YouTube Live, and they say, is these greedy sellers? And I go, well, is it really greedy? We all have one opportunity in our life. Now, if there's 10 people lining up telling you, I will pay you X for your house, and an appraiser says it's worth X minus $25,000, is it greedy to say which of those 10 people can give me X when the market has already told me? So sort of to answer your question,
why wouldn't it take highest and best?
100%. Appraisers do not determine what the market value is. They determine based off of the accepted appraisal practices, what they can put on paper is the value. And they will flat out tell you, I've had this conversation with several of the bigwigs at a couple of our appraisal management companies that we have to work through. And they said, it's not a bug, it's a feature of the system. When you have a rapidly appreciating market like this, Fannie and Freddie are fine making the loans. They're just not going to make them with low down payment loans. You're going to make up the difference. So Scott, it's not really up to the buyer, but what I'll say, again, going back to numbers never lie, most loan officers don't know the numbers and don't know how that impacts the borrower. We had one here where the borrower was putting 10% down. We knew that appraisal was coming in low, and he's freaking out. Like, if I have to come up with extra, then I got to take money from my business account, and I don't want to do that. I said, no, you don't. We can put the same amount down, and you no longer have 10% down. You have 5% down. So what has changed? Nothing changed. You put the same dollars down that you wanted to. The only thing that changed is his mortgage insurance rate was slightly higher. They had mid 700 credit scores, 2 borrowers. The difference in the mortgage insurance was like $40 a month. Do you want to pay $40 more a month, or do you want to take an extra $10,000, $12,000 out of your business account? I want to pay $40 more a month. So it's just a matter of, if you're not dealing with someone that knows the numbers and knows how all of these things are, and that's, I mean, people think that I'm just a cranky old man, that I get furious when you hear stupid shit like push button, get mortgage. There's no kid in the call center that knows that. They don't own a home. They've never sold a home. They've probably never been in a home. They grew up in an apartment. They live in an apartment now, and they go work in the call center. Like, cool. So you feel like they had a fancy app on your phone. They gave you shitty terms for your loan, and they couldn't advise you properly. I can go on for days. I can tell you how I really feel.
I was going to say, it's okay. You don't have to hold back, Ron. We're amongst friends. It's the same.
Oh my gosh.
So Josh, obviously you are an incredible source of information. Not everybody has access to the processing brain power that you have. Where do you recommend people go to, and how do they approach this? How do they find out what's real and what's not real? Do you have people that you follow that you think people should follow, or what kind of things? Is there 1 or 2 things that people should be paying attention to, and they can ignore all of the rest because it's noise?
So beware of free advice. People love to
like what we're giving right now.
Look, yeah, exactly. Beware of it. So trust but verify. Those guys sound like they know what they're talking about. But let me get some more information. All of the sources that I really, really put heavy weight in are paid sources. So some of those paid sources will write free articles that show up in the popular press. But if you're going through your Google feed and there's someone writing for the local newspaper telling you what this means because interest rates are up and what's likely, like, I keep seeing articles from so-called experts saying, well, we're going back to towards more historically normal rates. So that means somewhere around 4%. And this is what it means for values. Like, well, cool. Why? Why are we going back? Why is that normal? Because if you remember, when we went down to 5% after the tech wreck in 2000, we were going to get back to normal, which was 6.5 or 7%. We never got there. And then when they went down to 4 and everyone refinanced, well, get in while the getting's good. They're going to go back to that normal 5. And then they go down to 3.5. And everyone goes, well, someday we'll get back to that normal 4.5-ish. And right now we went to 2.6, 2.5. And everyone's like, we're going to get a normal like 3.5, 4%. Normal keeps moving lower, and it will continue to move lower. So you just have to know, is someone just parroting the historical party line that whenever we see a new all-time low, it's much easier to predict that we're going back to normal, however you define normal, than to say that this is a long-term predictable trend that's going to continue. But you asked a question about what are the sources. So I pay $1,000 a year for one of the people that I value. I pay $100 a month for another one of the sources that I value. I pay about $500 a year for one of the other guys. And, you know, Dustin, the article that I sent you this morning, thankfully I don't have to pay for that guy's service as part of one of the services that I have. This guy knows everyone and he reads everything. And when something good and important comes up, he sends it out as part of his service. So what I'd like to say is you have to make a commitment to seeking out knowledge and information. So if you want to be a source of knowledge,
make that a part of your daily routine.
Yeah, and it's not magic. I mean, you guys are going to find this hard to believe that despite this baby face, this is my 26th year in this business. So it's easy for people to go, well, bro, you've been doing this for 26 years. You should have figured some things out. And that is correct. But an example, another guy with a big YouTube following is Kyle. I don't even remember Kyle's last name. It's Win the Home You Love. Kyle Seagraves. He's 24 years old. And Kyle knows more than 99% of the people in our industry, and he's 24. And I look and I go, what's different about Kyle? And you talk to him. So he grew up in the business. So I grew up in the business. My mom was a loan processor. My step grandpa was a realtor. So Kyle, same situation. His dad's a broker, so he grew up around the business. Then he steps into the mortgage business, but he goes after the knowledge. He reads guidelines. We were the nerds back in the 90s before you had the internet and you would open a PDF. You would go to these giant 4-inch 3-ring binders and you would have to go through all the guidelines and read them. But from doing that, we know more than the person that we're coming across. And probably the best example I could give to any professional on this call, we have a client we're talking to about a $1.2 million loan right now. Yesterday, she sends over a loan estimate from another lender and says, well, I reached out and I called this person and they can do a better deal. And she sends it over. So the best part is whenever a borrower tells us someone's giving them a better deal, it's never a better deal. They just don't understand the loan estimate. But most importantly, I go through it. I look, Scott and I have a tool called MMI Intelligence, and you can look up any realtor or any lender in the country. The genius that she chose to call has done 16 loans in the last 14 months. So I suppose there could be a semi-retired genius gentleman in his basement that does one loan a month, but more likely this person has no idea what they're talking about. So you have to find a cool way to say it. But we get on the call, and about 2/3 of the way through our call this morning, I said, I saw the loan estimate you sent over. I don't know if you're aware of this. The gentleman you're talking to has done 15 loans in the last 14 months. And I would like to think at this point you had a qualitatively different experience in our conversation and the guidance that we're giving you than what you had in that conversation. Because yeah, he just sent over numbers and he's never followed up. But what I tell my clients is the people that get screwed the worst or make the worst decisions are the ones that talk to one person and just go with it. So I never get unhappy when someone gets a second or third or fourth opinion. But what I will always tell them is, give me a chance to come back and close the loop and answer anything they're telling you. And when we're done, if you feel like someone else better understands your situation, has more knowledge, and is going to put you in a better place, then you did your job because you have someone amazing. It's either me or someone that you've done the vetting and you think is better. So either way, you're in good hands. So it never happens that they don't. I had one earlier this week. We had the same conversation. The kid had started out with a high cost direct lender. He called me because he didn't like their closing costs. He called someone else in the meantime. He tells me at the end of the call, he goes, in all fairness, I just want to let you know I'm waiting for numbers from another person. And I just asked him, I go, we just spent 40 minutes on the phone. I think I understand your situation pretty well. I said, what are you hoping to get from them? He says, well, I want to see their numbers. I go, I can tell you that they won't beat us. If they do beat us, it will be by a marginal amount. I said, what amount of a discount would be worth you not having an expert on your side in a market with multiple offers, people getting beat out all the time and needing to know all your options? So just in terms of our conversation here, closing that loop, this is where that knowledge comes into play. If you don't have that, if you're a lender and you don't have that, and you're talking to one of my clients and trying to send over an LE, good luck. You are never going to win.
So I want to close the loop on some of those things. MMI Mobility RE, Ricardo, maybe you can put that in the thing. That's a really good company. If you're a loan officer and you're fighting with an LE from another company, go on to CFPB Consumer Access, right? Or what is it?
NMLS.
NMLS and NMLS Consumer Access. See how long that loan officer has been in business. See how many different companies they've been to. That's a good way to approach it. And Josh, do you mind sharing the geniuses that you draw your information from, the financial guys that you follow that you pay for?
So in terms of interest rates, when I started in the late 90s, there was one and only one guy. And this will tell you guys, despite the baby face, just how old this guy is. David Schurmeyer's system in the 90s was you signed up, you had to fill out a credit card form and fax it to him. And then, and then in the morning, you could call in and there was a recorded message telling you what the market was. And then at the end of the day, there was another recorded message. And he would fax you a week in review, week to come on the weekends, and you could read through it.
On your thermal fax?
Yes, yes. So all the youngsters in the audience are going, what are these old farts talking about? So
That's
I love David Schurmeyer, but he's
OG subscription model.
he is an old dog. He's been doing this since the 70s. So he has some really, he's very biased towards higher interest rates because he lived through the 70s and 80s when rates were just spiking. So that's his fear. He has PTSD of super high interest rates. But I love his opinion. I love what he's seeing because, like Scott said, you can sort of triangulate what you believe when you get enough solid opinions that you respect and know what their biases are. We all have biases. I have biases, but we try and round them out. So everyone in the mortgage business knows Barry Habib. Barry Habib is great. Everything I know about technical analysis came from Barry. And that will tell you the limitations of my technical analysis because Barry goes very broad. And he doesn't go super deep, and it's not because Barry doesn't have that knowledge. It's because most of his consumers, his business consumers, don't want that level of depth. So it's really good. It doesn't go too deep. It gives you the bullet points. You get a video in the morning of him talking through all the important news about 10 a.m. West Coast time, and then a market recap. A guy I really love is Dan Rawich. Rawich goes full-blown nerd on all of the technical analysis, like things that are often over my head, but I like knowing that he knows them and the conclusions that he's drawing off of them. None of these men are infallible. None of them are geniuses. They think hard. They have experience. They've been through different markets, and hearing all three of their opinions every day lets me know. Now, the guy that knows everything, or at least he's has the information, is John Malden. John Malden, he has multiple newsletters and services that you can subscribe to, but his primary business, he is a fund manager of fund managers. So if Dustin goes out this weekend and wins the lottery for $100 million, you don't want to give one financial advisor your $100 million and risk losing it. So you would give $10 million to 10 people. Well, Malden picks those 10 people in non-correlated type of investing. But the important and fascinating part about John Malden is he has freshly minted MBAs that he hires to read literally everything. And they decide, is this good and important? If it's good and important, it goes to his desk. Then he reads it. And if it's good and important, he then passes it along to you. And the stuff that comes across, the thing that I love about Malden more than anyone else, he loves hearing contradictory viewpoints. So Dustin, I have to find the article, but when he posted the Hoisington's newsletter that was talking about rates have nowhere to go but lower, there's another gentleman that thinks we're going to see spiking inflation and runaway interest rates. He's wrong. He's wrong, and his information's insane. But at least I read it. But the cool thing about Malden is you always have the differing viewpoints, and he'll put it up there, and he'll even say, I don't agree with this person, but this is a really smart person, and you should understand that side of the perspective.
Now, I want to really quickly, you've pushed back against the idea that on a long-term analysis, maybe even on a short-term analysis, the rates are going to go up. You feel like they're going to go down for all the reasons that you've given. But I just want to be really clear. What do you consider to be up? So you do not think that they're going to rise above 4%. You don't think they're going to rise above 5%, but they could go from where we're at now to 5%. Like, give me a sense of where you think they're going to kind of hover.
I don't think that the four of us here are ever going to see 4% mortgage rates again in our lifetime.
Whoa! Seriously?
Wow, that was a bomb.
So could we get really close to it? 375, 3875. So and why? Well, let's put it into context. Okay, right now the spreads between mortgages and 10-year treasuries are as low as they've been. A year ago, when COVID jumped out, they were as big as they had ever been. So right now, we're about 1.3, 1.4% above treasuries. So treasuries have been bouncing around between 10-year treasury, which most closely tracks the mortgage-backed securities and mortgage rates, has been bouncing around between 1.6 and 1.75. So that 1.4 margin means we're at 3.125. So historically, they haven't stayed down at that 1.3 spread. It's more like 1.6, 1.7 over time. So you're telling me to have a 4% interest rate and a 1.6 spread, we have a 2.4 treasury. Our government can't pay 2.4% on 10-year treasury debt and what that means for the rest of the yield curve. It can't happen. So again, there's only two options for that. Either Armageddon, our government defaults on all their debt, or they find a way to keep it below that level. So I'm not just pulling numbers out of my ass and saying, hey, this is what I hope, think, believe. It's just the reality of where we're at. Of course, I'm going to draw a blank on the guy's name, but another really smart dude popped up He's in the camp that he's worried about inflation. He says, if we get above 2%, we have really big problems in this country. 2% on a 10-year treasury. Like, yeah, we do. That's why it ain't going to happen.
Okay, so how low do you think it could go?
So that's the $24 million question, because let's look back in 13 and 14 when the government really was buying mortgage-backed securities heavily. I think like the lowest we ever got on our best day with 0.0 lender fees on a 30-year fix for the best qualified borrower was about 3.375. So if you look at the Freddie Mac primary mortgage market survey, it's probably more like 3.55, 3.6. But for brokers who are better than any other channel, the number was about 3.375 with no costs. So at that point, we're like, really, why would anyone make loans lower than this? It just won't happen. Well, now in this last downturn, we saw 2.625. And when did that happen? The treasuries had already turned up when we hit the lows and the levels. It happened when lenders had worked their way through all the backlog and had capacity and wanted to get competitive and fight against each other. So if you have another dip, you'll get a big backlog and lender margins will increase. But when you get past that, where is the real number? So we saw like the lowest we got was a 0.8 treasury. So 0.8 treasury with the 1.3 spread that we have right now would tell you 2.1. We had at the worst point a 0.3 on the 10-year treasury. That would get you to about a 1.6. So like a theoretical absolute lowest you could see the interest rate is somewhere in the low ones, 1.25, 1.5. But I don't think it's going to just go straight there. So we saw the world record lifetime lows of 2013, 2014 at about 3.375 became the world record all-time lows of 2.625. The next round's probably 2 1/8. And then 3-4 more years later, we get another shock and we're going to see 1.5. It is going to happen. We can pull this video out when it happens. Or if we spike to 5%, you guys can plaster this around. This idiot knows nothing.
That will be the title of the
episode.
Our guest moron told you exactly wrong.
So at a high level, coming back out of, and thank you for all this information because it's more in depth than anything I've been able to pull together, and I really appreciate your analysis. Coming back out, if you are a real estate agent, if you are a mortgage broker, you're talking to first-time home buyers. Your game, your question set is not around, hey, our mortgage interest rate's going to spike up. That's not, in your opinion, that's not the conversation to be had. The conversation to be had is stuff like, what's the supply? Because, if a bunch of supply is going to come on the market, then that might drop the prices of houses depending on what the demand is, right? Like if somehow magically California were to just like wave a wand and ignore most of their ridiculous, codes around building and entitlements were to drop by hundreds of thousands of dollars. And then all of a sudden, you get all this, building up in the, I don't know, whatever. Anyway, point being, we go from 1 month supply to 6 month supply. That would impact the price of home. Or if you move out of state where they're doing a lot of building, a place like Idaho, a place like Texas, a place like Florida, a place like Tennessee, then you might be more competitive there. So that would be one thing to look at. And then another thing to look at is how long do you want to be in the home? Because interest rates, if you buy now, yeah, you're maybe going to be in a situation where you paid, like you said, $30,000, $40,000 too much money for the house. But, fast forward this clock, if you're going to be here 7 years and maybe it's going to be a 20-year home for you, in 7 years, the interest rates on your predictions might be down in the ones. And then your mortgage interest payment on that's going to be, it's going to be so ridiculously low. And your house is going to be worth a ton of money because there's still no supply, right?
So 100% doesn't, and close the loop there. If we're saying at 3% with this monthly payment, this home is worth X, at 2%, it's worth that much more. And you have increasing wages. Maybe they're not increasing as rapidly as what most people would like. They're not keeping pace with historically what they've done. Wages go up, interest rates go down, home prices have to go up. And kind of one of the last things I'll say here is, we talked about be careful of free advice like you get on a podcast, but also be careful of the person who is telling you something and they're not taking their own medicine. I'm buying a house right now in Orange, California, and normally you would sit here and say, it's a total fixer. We're going to fix it up. And you would say, well, I can flip it. I'll make 60 grand, 80 grand, 100 grand, whatever the number is. And you go, why would I do that? There's none of these things around. I can put it on the market. I can rent it. It almost pays for itself. I feed it just a little bit. If we're correct and it goes up 8% next year, that's $60,000 more. If it goes up 5% the next year, that's $40,000 more. So, and when I say if we're right, it's not a question. Like they can't go another direction, barring something really unforeseen like a pandemic. The die is cast for what the government has already done and can do going forward. They can't allow rates to go any other direction. And just in case we have someone really smart in the audience and is saying, well, wait, the government can continue buying treasuries, which keeps their borrowing low, and stop buying mortgages and let mortgage yields go higher. Yes, they could. You know what would happen if they did that? It would crater the housing market. Housing wealth is the greatest predictor of spending. So people would stop spending and everything else they're doing to stimulate the economy would fall like a house of cards. It cannot happen.
The last thing, Josh, I don't want to go too long on this, but when we saw rates dropping, we saw one of the most ridiculous practices that I've probably ever seen, and that was buying discount points to get a rate lower than the lowest interest rates we've ever seen. And that's money that could have been spent for down payment for these higher costs. We've had this conversation before, right? Never pay points for an interest rate.
Absolutely. Yeah. Until we see a break of this 40-year downtrend in interest rates, until that breaks, never pay for a mortgage.
Until the 40-year trend breaks, is what you're saying?
Yes. Yeah. And it's not going to happen. It's not going to happen anytime soon. I don't know if I told you guys that, but it's not going to happen. So, and
I recall
something along those lines. And what we always see, it doesn't matter what the absolute interest rate is. When you see relative interest rates increase, like we've seen up 0.5%, we get people saying, well, I have the money. I'm just going to pay 2 points. Get me that 2.625 from last summer. I think, no, I'm not going to steal your money in the bank or your equity in your home on a refinance to get you a vanity interest rate. Doesn't make sense. We're going to get it for free. It could take 6 months. It could take 36 months. It could take 60 months. But sometime in the next 4 to 5 years, you're going to get that rate or better for free.
Yeah, but if you can be the first one to own the rate equivalent of a Cybertruck, wouldn't you want to?
Imagine the bragging rights.
You'll be at a party and someone's going to ask your interest rate and you're going to be able to just drop it.
Dustin, you don't actually have to have the interest rate to drop that interest rate at the party, because all we heard last year is, we were barbecuing last weekend and my neighbor got 1% and they paid him $10,000 to take it. I'm like, oh, that's interesting.
You're the one.
I could just lie.
You can just lie. You just tell them whatever you think is better. You wait till the other neighbors say what they got, and then you go 0.25% lower, but make sure you got a big lender credit for it also.
And on that bombshell, it is time to wrap up. Josh, where can people find you? Obviously, you were kind enough to let Jeb broadcast on your channel, but where can people find you on YouTube and elsewhere?
So Scott and I are building out the YouTube channel for Find My Way Home. There's going to be a lot of my content there. So just look up Find My Way Home on YouTube. And we're going to be building out the Buywise channel, more California-specific stuff for those of you in California. And anyone that has any questions, professionals or actual borrowers, email's always good, josh@buywise.mortgage.com.
Awesome. And Ricardo, you helped someone find Scott. Where can people find you?
Oh, my gosh. RicardoBueno.com. Thank you for the people who actually listen.
Who listen and then say, hey, there's a guy I should talk to. Awesome. So RicardoBueno.com. You have a podcast. You have a newsletter. It goes out multiple times a week. I know this because my spam filter gets it. I'm just kidding. I read them all. All of them, without fail. I've never missed one. They're really good.
Awesome.
It's really good stuff.
I yell back at his clickbait headlines.
That's awesome.
That is awesome.
He's over at findmywayhome.com, along with Josh, doing some really great stuff there. You can find me at lighthouseescrow.com, where if you're trying to figure out how much it's going to cost you to sell your home or to maybe buy a home and you're trying to figure out closing costs, lighthouseescrow.com. Scroll down. You'll see a calculator. It's for free. You can use it. Awesome. It's been great, Josh. Thanks for coming on. Until next time, this has been the Marketing Trench.
Yeah.